this next class is going to be fraud environment. Donald and Nikki stole my thunder because for the first half hour we're going to talk about internal controls and the SEO's internal control guidelines, and then for the second half of the class, then David is going to talk more about fraud. Okay, so these are the 4 things that I would like to cover in the next 25-30 minutes. First, a little bit of the background information, and then a very brief overview of the integrated framework of internal controls. And then we're going to spend some time in talking about the SEO's internal control guidelines, which became effective January 1st, 2015. And then just go over some of the additional resources you can find on the internet. Okay, so first background. So why are we talking about internal controls? If you are one of our Mason Associates clients, your auditor pound that idea into your head. You get an interim accounting issues memo, you get a final accounting issues memo, and you get a final MOIC. Why are we still talking about it? So what we see in our clients is that when we talk about internal controls, a lot of times what they think about is segregation of duties, which is a big part of internal controls. But there are actually many other aspects of internal controls that we are hoping that today, we're going to talk about it. Maybe then you can go back and look at your organization to see if there improvements can be made. And also, a couple years ago in Sacramento, somebody was worried about internal controls of local government. And what do we do to fix the problem? In California, we passed a legislation to fix a problem. Therefore, I forgot the number of it, AB 1248 became effective, and which requires the state controllers to publish guidelines of internal controls for local governments. So an overview of the guidelines. Now keep in mind that these are guidelines, so they are not requirements. So initially the legislatures really wanted requirements. However, there's no really one size fits all. All the local governments have different sizes, different challenges. So eventually these became just guidelines. Basically they're suggestions. The guidelines were written based on current standards and practical guidance. And so they basically integrated what is called the COSO's integrated framework of internal controls, which we're going to spend a few minutes talking about it. So in case you wonder, COSO stands for Committee of Sponsoring Organizations. So there are 5 different organizations in the accounting and financial field, including the AICPAs. They got together, I think it's since the 80s. So what they do is they issue concepts and frameworks hoping to help organizations to reduce fraud. So let's take a few minutes to talk about this integrated framework of internal control, since this is what the SEO's guidelines are based upon. So what the framework says is that essentially, when you think about an integrated framework of internal control, essentially is all the practices in an organization and your policies and your procedures, and what kind of environment is that to create, to allow the organizations to operate efficiently and effectively. So if it is a healthy internal controls environment, the internal controls should be able to adapt to changes, it should be able to support sound decisions, and it should also be able to mitigate risk. So the COSO's framework assumes that organizations have 3 different objectives: operations, reporting, and compliance. Operations mean that you want the organization to function effectively and efficiently. You want the assets to be only used for business uses. You want financial and non-financial goals to be met. Reporting means that You want reporting of non-financial reports or financial report to be transparent, reliable, and timely. And finally, compliance means that you want the organization to adhere to laws and regulations. So there are 5 areas of internal controls that an internal control framework should address. So they are control environment, risk assessment, control activities, information and communication, and monitoring. Essentially, an integrated framework of internal control should provide for a favorable control environment, periodic risk assessment, effective control activities, effective information and communication, and ongoing monitoring. So that's the expectation that you need to, for all your policies and procedures, it should hit all 5 of those components. Not every single one, but together under this environment, it should address all of these different components. So this is what we call the COSO internal control cube, or people call it the COSO cube. On top, that's where the 3 objectives are. And in the front are the 5 components. And we're not going to talk about on the side. Basically what that is, it talks about how sometimes because of the structure of the organizations, certain internal controls will only apply to a portion of your operation. For example, if you have a utility fund that may have different internal controls than the city as a whole. Not to give out how nerdy we are, Amy and I, when we first saw this, we were so excited. We were going to find somebody to make models of this as a stress ball and give it to our clients. So it can be very exciting for some of us. Okay. But then we were told there's copyright, so we couldn't do it. But so anyways, you could have gotten one otherwise. All right, so let's talk about this SCO's internal control guidelines. So what we're hoping to do is today we're going to go over each of those 5 components and go over some of the suggestions of what you can do to improve the internal controls environment of your organization. Okay, let's see. So essentially, the first one is what they calls the control environment. It covers management and your board or your council. Basically, it's what it sets the tone on top. You know, what are the functions, attitudes, how important they see internal controls are to the organizations. So this is seen to be, this is considered the foundation of the other 4 components, because you do need to have a good culture to support the practice of good internal controls. So, you know, things to pay attention to is, you know, the culture of the organization's tone on the top, what kind of performance or disciplinary actions are in place. So let's say that you kind of think about your organization. You go, yeah, the culture is okay, but not good. What can I do? So the guideline does have some suggestions of some of the areas that you can focus on to improve the culture of internal control, the control environments of your organization. So the first one is the organization's integrity and ethical values. You can develop a code of conduct and distribute it and practice it, or if you have elected officials, you can send them to ethics training. So that's some of the examples. The second one is government board's oversight responsibilities. Maybe task your audit committee or your finance committee to follow up on the audit findings. So that will be, you know, just kind of get them involved in the process of overseeing the audits. The third one is assignment of authority and responsibilities. So if you put into your policies or procedures that there are certain reporting lines established, so that will improve the culture of your organization. The fourth one is process for attracting and developing and retaining employees. Do you have a succession plan for your key employees to prevent lapse of internal control when that person retires? So that's something that you can put in place. I know that it's hard nowadays to hire people in advance, but it's just something to think about. If you have this star employee that is a key part of your internal control structure, and that person is going to retire in 2 years, maybe start thinking about how to replace that person and train that person before that the next person before this person retire. The last one is accountability for performance. If you have performance measure, that will help. Okay, the next one is risk assessment. I believe Donald and Nikki have gone over a lot of it. So essentially, what we're talking about here is that you need to kind of look at your organization to make sure that on an ongoing basis, you are identifying, analyzing, and managing the risk. And the risk that we're talking about here is the risk that will prevent you from achieving those 3 objectives that we talk about: reporting, operations, and compliance. So risk assessment, you identify the risk, you estimate how significant each risk is, then you assess the likelihood that it will happen. Then you have to decide, okay, if it happens, what we're going to do. So you should have a plan of attack before it actually happens. So you kind of have to think about it so you don't become reactive. So what can you do to ensure there is more proactive risk assessment in your organization? A couple of examples. Make it a habit of sending yourself or your staff to conferences, accounting conferences or IT conferences, so they are, or HR, conferences, so they are up to date on what are the standards out there and the practice, so that they can come back and assess risk of the organization. Also, when there are changes of software, make sure you have a plan of attack beforehand. Decide when you're going to run tests, and if problems occur, what you're going to do about it. So these are like more of the proactive measures. Risk assessment for year end, sit down with the person who's going to close your books and talk about, hey, we have these unusual unusual transactions this year, how we're going to take care of it. So this year the example would be GASB 72. You go back and you think about, okay, what kind of report do I get from my investment advisor? Do I need to ask for additional information? What kind of report am I going to produce in-house, stuff like that. Okay? Then control activities. Now this is the one that I think we're most familiar with. So essentially, first you look at the environment. Then you think about, okay, well, what are my high-risk area? Then now you look at, based on those high-risk areas, then you review your policies and procedures to make sure that those areas are addressed. So keep in mind that the cost of implementing the control activities should never outweigh the benefits. So for some of the smaller organizations, a lot of times, it may mean that it's a very low-tech review process, and it may involve your elected officials. So the guidelines listed out a bunch of like 5 different elements that policies and procedures should cover. First is authorization. So your procedures should clearly identify what kind of activities should be authorized by whom. Secondly, performance reviews. This is not for employees' performance reviews. This is more like you need to kind of have a habit of doing analytical review, maybe a quarterly analytical review of your financial statements, so to identify any unusual transactions. Thirdly, information processing. So there are two types of controls under information processing. Application controls mean that when you have input some data, you should look at the output to make sure that it is really in the right place. So an example will be if you have to set up a new deduction in payroll, if it should be pre-tax, you should run a few transactions through to make sure that the end product really reflects that is pre-tax instead of post-tax, stuff like that. Then general IT controls that Donald has covered a lot of it. Physical controls, we're talking about tangible and intangible control assets here. So tangible will be, your land and your equipment. Intangible, sometimes people don't think about this. Like, for example, your payroll database that needs to be safeguarded too because it has a lot of information. Frauds can be committed. So there got to be procedures in place to safeguard those intangible items. Finally, segregation of duty. This one, everybody is familiar with. Examples will be authorization versus execution. Those two should be separated. Record keeping versus access to the custody of the assets. That should be segregated. Okay. Next one is information and communication. So the concept is very simple. So now you have all these procedures in place. Then you have to decide, well, what kind of reports can best serve me in maintaining good internal controls. And communication means, well, who should I communicate these reports to so that we can ensure the check and balances. So conceptually, they are very simple, but I'm going to give you a few examples because what we notice is that a lot of the times, this is the area that people don't really think about. So this example, I have one of my clients, I was doing the SAS 114 meeting with the council. So I asked them about fraud, like they're trying to feel what their attitudes are and stuff like that. And then they go, oh no, we're totally on top of it. So they have procurement procedures. The city manager can only authorize up to, I forgot, let's say $30,000. So they say, well, we actively monitor it. I'm like, well, how do you do that? Well, every month, the city manager put it on an Excel spreadsheet of what he approved the month before. So we want to make sure he really didn't go over the limit. So this is an example of a very poor information. Like this report just does not work, because it's self-reporting, is on an Excel spreadsheet. I mean, it serves no purpose. If the person is going to commit fraud, they are not going to put it on the Excel spreadsheet. So I was trying to tell them in a very nice manner. I'm like, okay, where should I start? But anyway, so if you're trying to monitor a person, activity, it got to come from the system or from a different person, right? So another example which we see very more common is that we ask the client, well, do you review journal entries? And they say yes. Well, do you account for the journal entries number? They're like, no, so and so will do an entry and I approve it. And I give it back and they put it in the system. So well then how do you know they are not going to just write a journal entry and post it without sending it to you? So so that's another example of like just the quality of the report dictates how effective your internal control is. Okay? So, and then for communication, I have an example for communication that we see very often, especially when the other departments have a different system. For example, it's cash collection. Parks and Rec have their own system. And then so they collect money and then somebody brings it over to finance. Finance put it in the bank account. But information never gets back into the department to reconcile the two systems. So fraud can be committed, and we have seen it a few times, that people can actually steal money in the middle because communication lines were not established well. Okay? So a couple other examples of information and communication. Sometimes council goes, there are council meetings and they make some great decisions, but then they don't tell finance about it. So all of a sudden they make this, they pass these things, and then 3 years down the road, then you found out. So what we suggest is that somebody at finance should review the minutes or the resolution afterwards to make sure there are no decisions made without your knowledge. Also, we have also seen sometimes policies are very well written, but then they are not communicated to the employees. So there is a current practice, and then there's a policy here, and they don't really talk to each other. So then we as auditor, we write all these findings. You're not complying to your policy because it requires a PO for everything over $500. They're like, oh, we haven't done that for 10 years. Well, then you need to update your policy, because now the policy is not being followed, so it's not being effective. Okay, so last component is monitoring. So basically, you got this great thing set up, right? Like you assess your risk, you have policies and procedures, you figure out the right report, you figure out the reporting line, but did you really do it? So that's basically what this is, monitoring is. You got to have a system so that everybody is doing what they're supposed to do. Okay, now you don't have to raise your hand, but just ask yourself, how many times have you told somebody, or you did it yourself? After you review a monthly report, you go, gosh, I better sign and date that thing because my auditor is going to write me up if I don't. Oh, wow, we have hands going up too. Okay, so we will write you up, but the idea is that we want somebody in your organization, to be able to verify that actually happened. And it got to be ongoing. It got to, you got to really look at it, because you don't know if your accounting manager is really reviewing that monthly reconciliation, if that is a key control to your internal control structure. So again, continuous monitoring is the key. Also, if there are new challenges, you have to go back and make sure that your policies and procedures address that. One good example is I have probably half of my clients that don't have a credit card policy. Because when the city was incorporated in the 60s, there was no CAL card. So the purchasing policy kept being updated, but then no one thinks about, hey, maybe we should sit down and do this CAL card policy, because it was never done. So make sure that part of monitoring is to ensure your policy also keep up with the challenges you're facing nowadays. Okay, so if I inspire the heck out of you in the last 20 minutes and you're dying for more internal controls, 3 places that I recommend. The first one is what we call the Blue Book. GFOA published this thing called the Governmental Accounting, Auditing, and Financial Reporting, which is a great resource for basically anything governmental accounting. Chapter 42 is a really great chapter if you want to introduce your staff to internal control. Just have them read that. GAO has a tool that can help you evaluate the internal control of your organization and how you can improve it. Finally, if you want to know more about that COSO Cube, there is an executive summary under this link that you can feel free to explore. With that, are there any questions I can answer for you? No? Well, thank you very much. And just if you can give us 1 minute, then we'll switch it to David. Thank you. I'm not even going to move.
Can you hear me? Try not to get this thing dropped or anything. All right, so we're going to talk a little bit more about the fraud environment. Just kind of a disclaimer, the things I'm going to talk about are more just kind of general of what a fraudster looks like, how to detect fraud. This does not go against your own internal controls. You need to do your own due diligence. Just like to come out and say that. So what we're going to go over is what is a fraud? Why is fraud prevention important to us as stewards of public funds? The fraud environment, how to spot a fraudster or liar, which I particularly really like. I think it's kind of fun looking at the statistics of what typical demographic of a fraudster is. The fraud triangle, everyone has seen it, but I just like to talk about it just a little bit more. Adequate internal control environment, some common fraud schemes that we see out there. Some tips and tricks that you can use to help your agency, and then we'll just go with some small closing comments. So what is fraud? So fraud is a wrongful or criminal deception intended to result in a financial or personal gain. So a couple things there. So it's deception, so it has to be misleading, kind of like a lie, right? A lie, when you speak a lie, it has no power, right? It only has power when it's accepted as truth. So we have to mislead somebody. It has to be intentional. It can't be a mistake, it can't be an error, and it has to result in some kind of personal gain. And that can be financial, that can be non-financial. You know, you're punching a time card for somebody because they're running late and you know they need to get paid. You know, you're helping somebody out, you're covering for somebody. So this chart is from the Association of Certified Fraud Examiners report to the nation. They're 2016. It just came out a couple months ago. Unlike everything else we said to read to put you to sleep at night, do not read this because this will scare you and you will want to put your money under your mattress. Okay? So 18% of all frauds reported. Oh, and this report to the nation, all certified fraud examiners, when they find a fraud, have to report it to the association. And then every 2 years, the association puts together this report of what they've found. So 18% of all frauds committed are in the banking or financial service industry. 10.5% are government and public administration, 8 in manufacturing, 7 in healthcare, and 6 in education. So 1 in 10 frauds happens to you guys. Why is it important to prevent fraud? Well, it's costly. It costs us time, money, people. You know, we've lost some people for that. The median loss is $150,000. But 23 of the cases in the association's report were greater than $1 million. And the median time to detect is 18 months. And we found that the longer these frauds continue, can you guys read that? I guess it's slow. Okay. The longer these frauds go on, the more costly it is to the organization. 82% of all fraudsters do not have a criminal background at all. So they're not the typical, you know, motorcycle riding, tattooed guy that's going to steal from you. Unfortunately, it's probably the little old lady sitting next to you. It's been there for a long time. That's how it is. So how much does fraud cost us? Well, it kind of depends on who does it. If you're an employee that's only been there for less than 5 years, it's usually around $64,000. If you're a manager, $85,000. An owner or executive, around $600,000. So you see, the longer the employee has been at the organization, the higher the loss potential is. So some of the other costs are the forensic audits. Granting agencies usually will send their people in. State agencies will send their people in. And if you've ever dealt with a state auditor, we're a lot nicer than they are. Partially because they have an unlimited amount of time that they can bug you. We only have a little bit. And there's also non-financial costs. I mean, the embarrassment to the organization. It's more than a financial statement impact. It's the embarrassment, the loss of trust with the organization, dealing with public funds. You know, I've seen accusations, wild accusations, being picked up by the news media and just ripping apart organizations, dragging them through the mud. Their good name. I mean, these were just wild accusations, and it costs this organizations hundreds of thousands of dollars in time for public requests, legal fees. The auditors had to come in and do additional work. It's just there's a lot of, I guess that's really a financial cost, but there's a lot of other costs associated with it. And even some of the frauds that you see out there, I mean, it seems like sometimes they never go away. Even City of Bell, which really wasn't technically a fraud, it was more just mismanagement. I mean, we still talk about that now, and that was how long ago? So they stick around for a while. So this is kind of a chart about the types of frauds. So corruption, misappropriation of assets, financial statement fraud. So corruption would be a scheme where an employee misuses their influence in a business transaction to have personal gain, like kickbacks. Asset misappropriation, that's actually money physically walking out the door or inventory walking out the door. And then fraudulent financial statement reporting, that would be using the journal entry process to make your entity look better or to hide something. So a lot of times when we see fraud, it's not just one of these things, although 57% is just money walking out the door, but sometimes fraudsters use multiple items. So they'll get kickbacks or they'll steal money, and then they'll cook the books to hide the money that they're stealing. So it's hard to detect where their focus is. So this is really big, and we're not going to go into all this, so don't worry. But we have the three at the top. You have the corruption, the asset misappropriation, and the financial statements fraud. And then the two that we really see most often are skimming and like billing schemes. So that's the kind of, or disbursement schemes. So that's what we're going to focus on later on. So how to spot a fraudster? So this is where it gets fun. So we have here the age and the percentage of fraud is considered or happens. So the stats are that it's usually going to be an employee 1 to 5 years. That makes up 45% of all cases. If the employee is there for 6 to 10 years, it's 23%, and over 10 years, it's 25%. But you have to remember that, like I said, the longer they're there, the more risk of a loss there is. Out of 40% of all cases, the fraudster was between 35 and 45 years age. But the highest level of loss is if they've been there for if they're over 56 years old. And it kind of depends on where you work within the organization. So if you're in accounting, you have 30% of all of the frauds in accounting were check tampering, so changing the name of the check, and 27% were billing schemes. If you're in operation, you're more likely to have some fun with corruption. It's a little funner in operations, and sales as well. Corruption are the two highest. And your fraudster probably doesn't like to, or doesn't have a criminal record, like I said before. 86% don't have a criminal record, and only 5% actually have prior convictions. And they rarely go on vacation. You can't cook the books sitting on a beach in Maui. So even though you use the money to buy the beach house, but anyway, you can't use it. So these are some red flags, and again, these are things that actually, going backward a second, I just want to say something that a lot of these profiles that we have, I mean, the age, the longevity of employment, that they're in accounting, it's really hard because this is a lot of people. I mean, this is a lot of us, right? I mean, we all kind of fit this profile. So, I mean, you guys are all in accounting. So it's very hard to detect. So again, that's where the red flags kind of come in. And these aren't things that by themselves, like, oh, this person is a wheeler dealer, he must be a fraudster. These are just red flags, just to kind of keep your head on a swivel. If you start seeing 3 or 4 of these come together, that's really what we're going. It's really funny. I'm reading a book called Lie Spotter right now, and it's really interesting because eventually I'm going to have 2 teenage daughters. And this is going to be great, because I'm going to look at the boyfriend in the eye and really ask him some hard questions like, oh, you blinked. I see that little sweat coming down your brow. But anyway, so like that, those little things are red flags. They're not necessarily, oh, he's lying, but they're red flags. So living beyond your means, okay? You really like those Louis Vuitton purses. They're really expensive. But financial difficulties, you have money woes because you spend all your money on Louis Vuitton purses, right? Really close vendor relations. So that would be kind of indicative of kickbacks or corruption. A wheeler-dealer attitude, kind of, I'll get it done, I'll handle it. Addiction problems, which is really hard because usually they're unknown that you like Louis Vuitton purses and you have 2 closets full of them at home. Refusal to take vacation, because you're constantly cooking the books, and control issues. You're not willing to give up duties. And those last 2 are kind of key. And a lot of our internal control testing, when we're looking at cycles, especially like disbursements and payroll, we kind of cringe as auditors when that payroll clerk says, oh, I just plan my vacations around payroll cycle. We're like, that's kind of not what we want to hear. We want to have good cross-training so that somebody else can look in and see what's going on. So the fraud triangle. Has anyone not seen the fraud triangle? Okay, so we'll go quick. The first kind of line on each one is a kind of a typical fraud. The second one is a more honest one, if there's such a thing. And then later on I'm going to share a personal story of how one of my bosses, actually my previous employer, is sitting in Santa Rita right now. So we'll talk about that later. But so the pressure is, I have a gambling problem. I like Louis Vuitton purses. I have no money. The rationalization, especially now, in government, times are tighter. Finances are less. You're paying for part of your pension, your OPEB. So actually that would be more of a, well, anyway. But I'm disgruntled because I'm underpaid for the work. We have furloughs, and then I have an opportunity. Bad internal controls. Nobody looks at bank recs. I can do this. So, but the pressure, that could be imposed by your employer. They give you less money. So now you have a financial pressure that's there. So it doesn't have to be anything sinister. It could be, imposed like that. So the second one, my spouse lost her job. I'll pay the money back. It's really funny how many of them say they'll pay the money back even after it's millions of dollars. What was that one, that campaign lady that had like $7 million that she had embezzled from that campaign fund? It's like, oh, I'll pay it back. Good luck with that. And then the opportunity, I can work around the internal controls. So this is my real life story, and I changed the name, obviously. But so before I worked at Mason Associates in 2004, as I was still in college, I worked for a small locally owned bank, as a privately owned bank in Oakland and in Montclair, actually. And they only had like 13 branches, really small. And the branch manager, the one that I worked out here in Montclair, he had been with the organization for about 20 years. And in 2005, I left and I came to work at Mason Associates. And right after when the financial crisis hit, this bank had been sold. Well, anyway, about 6 years later, I ran into him, and he told me that during the financial crisis, the bank was sold 3 times. So 3 times in like 6 years. And each time the bank was sold, his job was on the line. The new bank wanted to bring in their management, their system, their people. And so he was disgruntled. So, okay, well, that's one. He's disgruntled. He can rationalize it. Later on, after this hit the news, it was about 5 years ago that this came down, where what he was doing was there was a lot of really elderly, wealthy people at this branch that had, $1 million in a CD, a 1-year CD, and it would just roll forward every year. So what he was doing is he was stealing the money out of the CDs, doctoring the statements, and sending the statements off to the bank customer. And he was caught by one of the financial managers of one of these clients, and they noticed a discrepancy. And it turned out that it was about 16 people that he had stolen from over the course of a couple of years to the tune of about $2.4 million. So, and then I ran into, right after I heard that, I called the guy that got me the job, my friend, and he said, his wife was going through really expensive cancer treatments. So that may have been a pressure, I don't know. All I know is he threw the best Christmas parties. But he was sentenced to 12 years, Santa Rita, and restitution of the $2.4 million. And it's kind of crazy because it's always one of those things where it's one of those situations where I never thought it'd be that person. I knew him very well. I had a relationship with him and didn't think it would ever be that person, which we normally are surprised by. So with the internal control environment, there's types of controls. We have proactive controls, which would be your preventative things. That would be segregation of duties. Good hiring practices. If you have people touching your money, you probably want to do background checks and pre-approval limits, like Katherine was saying. Then you have your detective techniques. So that would be like your bank recs, your budgeted actuals, running exception reports. And then you have your correction techniques. That would be depending on what it was. If it was an error, correct it by a journal entry. If it was fraud, termination and possibly, prosecution. So the 5 components of adequate internal control: segregation of duties, and we went over this, but I'll just show you a graphic that kind of is a good example of what we mean by that. Is we want these 3 things to be separate in a perfect environment. You want the custody of the asset, the authorization, and the record keeping. So when we come into like a disbursement cycle, we want to make sure that nobody can record the disbursement, send the check out, and sign it. That would be pretty bad. But anyway, okay. So we kind of went over that earlier, so I'll backtrack back here. So proper authorization and transactions and activities. So we want, I'll go back to my notes here. So we want good policies that are actually being followed. Like Kat said, if you have a credit card policy that's archaic, you might want to fix it. Adequate documents and records. We need to have, as auditors, we need to have physical sign-offs, initial and date. The control didn't happen if we don't see that. So we have to have some kind of audit trail that's auditable. Physical control over the assets and records. You don't know how many times we've been in like doing a cash receipts testing, and we just take the money and we put it in the safe and we do a deposit at the end of the week. Well, who has access to the safe? Oh, just me. I have a key. Where do you put the key? In that unlocked drawer right there. Well, now everyone that comes through there has access to that cash, right? So we want to have physical control over the assets. And then independent checks and performances, so that would be spot checks are good, and surprise cash counts on your cashiers. So some of the common things that we see in billing would be false invoices, so PG&A instead of PG&E. Personal purchases. Again, sometimes we see that on the CAL cards, or actually, I had a sewer district where the employee was buying a lot of things from a really, I think it was like Granger, so you could buy like almost anything, and he was the inventory manager, and he wanted like a bell that you could come and push if he wasn't at his desk, if he was back in like the back room, and he bought one that made inappropriate sound. It was a sewer district, so you can imagine what the sound was. Not good. So we found it, and it was really embarrassing because I had to go talk to them about why they bought this thing that made this sound. But anyway, so fake vendors, we wanted to make sure we have segregation of who can set up the vendor databases. Skimming. So interception of payments coming in, usually they're not expected. So some of your revenue coming in is expected. If you get a check, some kind of weird deposit, there's more likelihood that that can be stolen because it wasn't expected. And then personal reimbursement for items. If you have a gas card, it should only be used for gas card for your entity, not your sedan. And I actually like to look for these when I'm doing my audit testing when times are tough and when times are tight on money. So around April 15th, maybe around property tax due dates, maybe around Christmas. Something to think about. Some other ones to check: tampering. This one I'll actually give you another example. We had a very small district, and they didn't really have a real finance department. They had an office manager who was kind of running the day-to-day. They only had like 3 people in their office. They had an outside CPA do the bank rec, which I thought was a good control. The check register was going to the board every 2 weeks to review, which is another good control. And every check required 2 signatures. So pretty good controls, right? The problem was she had access to the records. she had access to the signature stamps, and what she was doing was she was presenting the board with a check register with a known vendor on it, and then after the fact she was changing the vendor name to her name and sending off the checks. And the way she was caught is she had to go out on medical leave, and somebody came in and opened the drawer, and why are there 5 checks written to her? So that's how that was caught. So that's a check tampering. So payroll, ghost employees, we've had entities that have multiple, usually the smaller ones, like I had one as a nonprofit that they had two employees set up, and so they were getting 2 paychecks every pay period, kind of nice. Unauthorized pay rates, we want to make sure that our payroll clerks are checked as well, the people that can change the pay rates, and over contribution to retirement or pension or deferred comp plans. So this would be like if you, and I'm kind of, well, we talk about detecting them, but I'm kind of talking about it now as well. But this would be like if you had changed your withholdings to, you overpaid yourself $10,000, but then you changed your withholdings to be $10,000 for your federal income tax. So come tax time, you get a nice little bonus when you get your money back. And then non-cash items would be conversion. I had one where they were using the entity, one of the people in Public Works was using the company truck on the weekend to do a moving service and was getting paid to do that. So that would be a non-cash item. Okay. So let's see. I'm going to kind of skip ahead because we kind of went through some of these here. Sorry. So ways to look for check and disbursement frauds. So run a vendor listing. Look for similar names. Like I said, PG&E versus PG&A. David Alvey versus David Alvey and Associates, Look for high volume usage on new vendors. A lot of times people get pretty excited when they set up a new vendor to steal money, and they want to start doing it really quick and very often. Be concerned if the vendor is a PO address and not a physical address. Google them, see if they're real, if they really exist. Cross-check phone numbers against employee payroll records. If the phone number for your vendor is the same as one of your employees, you might have a problem. That's a good one. And then look for dollar amounts just under authorization thresholds. Again, when we do our testing of disbursements, we break out what the authorization levels are, and we kind of look around those to make sure that we're not just under a threshold for some reason. And if you sign checks, mail them yourself. That's kind of one of the easiest ones. And get on Positive Pay. Does everyone know what Positive Pay is? It's a great tool. I've seen it catch many pretty bad checks, actually. And this is more for like if you're a smaller entity, you can check your payments versus your cleared checks for your check register. That would have helped the one with the lady that stole the money. And then if you're using paper bank statements, have them sent to somebody else who processes it to kind of look at it to make sure there's nothing strange. For payroll fraud, look for payroll, let's see, oops, sorry, there we go. So look for journal entries at the end of the payroll cycle. Review the number of checks or electronic funds transfers. That's another way. Most likely people will have access to the payroll database, are going to be the ones that do the payroll fraud. So we always test the payroll clerk. And look at the payroll register, look at it gross and net to see if somebody is maybe putting more money into a withholding or something like that and can get the money back later. So for cash receipts, again, unexpected payments. So like I was saying, it's the unexpected payments that are more risky. So the example being cash first check. So if you have a cashier and they have, at the end of the day, let's say they're about ready to close their window, and they have $500 in green cash and $500 in check. And let's say all of a sudden a $100 check comes in, and wasn't expected. Nobody knew it was going to come. Well, I'll just put that $100 check in my till. I'll take $100 in cash and put that in my pocket. My till is still $1,000, but now the cash is understated and the check is overstated. So we want to be able to look at the reconciliation as well. We have schemes where the cash is taken after the initial sale. So in that, we want to look at voided transactions. So if I take the cash, give you a receipt, you're out the door, bye, void. So we want to look for those. And then diverting cash without giving a receipt. We always want our cashiers to give receipts to our clients. I kind of talked about that. Again, surprise cash counts, it's a great tool. Even if you do once, every once in a while, the risk of it is the fear is a good control. And then review voids and write-offs. So overall tip, just to kind of come down here, is we really rely on the bank reconciliation, and I can't stress the importance of timely and accurate bank reconciliations. Have customer complaints handled by somebody other than the person doing the transactions. So we hear from those customers if there is something strange going on. That's another way that we can kind of get a feeling if something's going on. Cross-training your employees, kind of like what Katherine was saying. If you have key employees, or even just to get a separate set of eyes on an area, it's a great technique, and it's good to be able to kind of fit people in where needed. Whenever we do our proposals for new work, we always usually put 2 partners on the engagement, one primary, one alternate. And I always say, if I was the primary, it's like, well, if I get hit by a bus, Katherine can take over the audit. I said that at a transit district interview. Not good. Didn't go over as well, but usually goes over pretty funny, but not there. So it is good to have continuity in your business. If I did get hit by a bus, we can continue to move forward. If you don't have mandated vacations, again, just rotate duties so that a few times a year that duty is covered by somebody else. So again, if you can't constantly cook the books if somebody else is doing your work. And then have a whistleblowing blower policy. It's kind of a cost-effective thing. Sometimes the whistleblower policy will turn more into a complaint department, and so you spend more time chasing down complaints. But we've heard some pretty good responses that they do actually work. So, how is fraud discovered? So this is kind of funny, actually. 45% is tip, 19 is management's review, so good detective techniques. 15 is internal audit. 10% is by accident. Yeah, that's a good one, right? 8 is by reconciliation process. And I showed it earlier, but only 3% is detected by external auditors. So we get beat out by accident. I love that. But I mean, we're not fraud auditors, and I mean, that's the thing. Well, anyway. So management is responsible for maintaining and monitoring internal controls. And kind of like what Don says, if you put an internal control process in place 10 years ago and you never look at it again, you need to be constantly checking that and making sure that it's working. Again, the use of a tip hotline are useful, and really the tone at the top. I mean, we want to see ethical behavior by everyone at the top. If it were me and fraud happened in my organization, I would like to see the person leaving the organization with police and in handcuffs in front of everyone, and be very clear, is that's what happens when you steal. It's a little rash, but that's the way I see it. And it's really hard because, to inform the public that although we are obliged to bring fraud to your attention if we find it, but we're financial statement auditors. We're looking for materiality, that they're materially correct and not free of fraud. So it's really management's role to set up good internal controls to mitigate fraud. And with that, I'd like to open up any questions.